Welcome to the Rose Show podcast. Today, I am so excited to be here with someone I admire who has created fascinating, innovative ways to diversify with alternative investment solutions. Julian Klymochko. He's an entrepreneur, a CEO, and CIO of Accelerate, powering diversification with leading alternative investment solutions. Julian, you facilitate diversification by providing investors with a suite of hedge fund ETFs, crypto ETFs, and Web3 funds. It's especially important during these challenging times to provide investors with alternative solutions as the free, easy money seems to be gone. Diversification is always key in reducing risk, and risk management is always number one. So we need to be creative, remain savvy, and seek alternative ways, as you have done. So how are you doing today, Julian? So honored to have you here.
Hey, Rosanna. I am great. Happy to be on the show and excited to chat about investing, diversification, all that good stuff.
Awesome. Thank you so much. Well, I think what we can begin with is tell us exactly what you mean by alternative investment solutions.
Sure. And alternatives can mean a myriad of things, but the simplest explanation is an alternative investment is anything besides stocks, bonds, and cash. So you look at the traditional asset classes, stocks, bonds, and cash, and anything outside of those can be classified as alternative. Now, under the alternative segment, I like to break that up into two different areas. Number one, there's liquid alternatives, which include hedge funds, commodities, currencies, crypto, things such as that. Liquid, meaning you can buy and sell readily. Then the second part is illiquid alternatives, meaning private equity, venture capital, private real estate, private credit, things that you can't readily liquidate, buy and sell, and you typically don't get a mark-to-market valuation on those private assets. And then there's certain subsectors, like if we want to talk about hedge funds, there's basically, approximately 10 major hedge fund strategies, whether it's long-short equity, the most popular, multi-strategy, global macro, arbitrage, market neutral, managed futures, and several others, distressed debt, and so on and so forth.
Love that breakdown. Yes, liquid versus illiquid. And so excited to get into those discussions further deeper.
Yeah, and the other thing that I should add with respect to alternative investments is what I consider a true alternative is something that has low, no, or negative correlation to traditional asset classes. And that's why they're viewed as portfolio diversifiers. Because if you can generate an attractive return that is generally uncorrelated with traditional asset classes, that to me is the true essence of diversification.
Agree. Now we're going to have a definition of what you mean by traditional asset classes, so we know it's not that.
Yeah, so the traditional portfolio is generally regarded as the old 60-40, 60% stocks, 40% bonds, and that's generally consisting of US stocks and bonds. So call it for stocks, the S&P 500, and then for bonds, a mix of treasuries and corporates, largely on the American exchanges. However, in contrast to that, if we consider the global market portfolio, US stocks and bonds are only typically like a relatively small portion of that, less than a quarter for sure. So the traditional 60-40 portfolio, it's only a fraction of the global market portfolio. And so some consider that taking an active bet, not quite as passive as some may think, but it is generally low cost if you utilize ETFs. So that's a good thing. However, what 2020 showed is that 60/40's track record pre-2022 was very good. However, in 2022, it suffered a pretty devastating setback, drawdown of or negative return of approximately 20%. Stocks and bonds became highly correlated. Traditionally, they were viewed as diversifiers. I remember talking to some professional allocators about 18 months ago, and this was back when the 10-year was yielding 100 basis points. I asked them, why do you own 10-year treasury bonds yielding 1% when inflation's higher than that? They told me, well, those treasuries are there to protect our stock portfolio for when stocks decline, as they generally do. Every, call it 4 to 6 years, we get a bear market. And that thesis was proved just enormously wrong in 2022. The 60/40 portfolio was certainly a beneficiary of the 40-year decline in interest rates, basically from the early 1980s to call it about a year and a half ago. And they've done nothing but mostly go up since then. 10-year peaked above 400 basis points, up from a low of 50 basis points. Now it's below 3.5. That being said, many, including myself, believe that 40-year bond bull market is over. We're in a new regime where we're having high inflation. And if you look at the data, historically, stocks and bonds haven't been negatively correlated. More often than not, they're more so positively correlated. In addition, in an inflationary environment, they are usually positively correlated. So that 60/40 portfolio lost its main diversification benefit. And if you followed my Twitter feed, one tweet that I really liked that symbolized 2022 is if you compare TLT, the long-term treasury bond ETF, with the QQQ, the NASDAQ ETF. In 2022, is basically the exact same trade. Both were down well north of 20%, and they're highly correlated. So it looked like whether you own tech stocks or long-term US Treasury bonds, it was effectively the same asset, because at the end of the day, both are long duration financial assets that are influenced by the same fundamental factors. You've seen a bit of divergence this year. Interest rates have really whiplashed investors. Basically, each month they've gone up and down and up and down with wild swings in the 2-year and 10-year treasury yield, a massively inverted yield curve. But that's a bunch of macro stuff that we can get to later. I gotta get back onto what.
I love it. I'm getting so excited to go into the yields now.
So in summary, with respect to kind of the macro and performance of traditional asset classes in 2022, diversification is as important than ever. You had many alternative strategies that were not only up in 2022, when both stocks and bonds were down double digits, both in bear markets, but some alternative strategies were up double digits. And I felt like many investors just didn't know those were available to be invested in. And if we look at the endowment portfolio, for example, the Yale endowment, it's dramatically different than the traditional 60/40 portfolio. They're heavily weighted to alternative investments, just over 50%. They have a lot of exposure to hedge funds, private equity, real estate, etc. And their domestic, i.e. US, equity and fixed income portfolio is in the single digits. So it gives you a sense of how are the most sophisticated allocators investing? Well, a single digit allocation to US stocks and bonds. Meanwhile, the traditional portfolio, that gold-plated 60/40 portfolio that was relied on for so long and provided great returns, many allocate 100%, like their entire portfolio, to just those two assets, which in 2022 became one asset. So absolutely. I think we've had a regime change there, a change in thinking, and people are finally understanding what the institutional asset allocators realized decades ago with their endowment model is that, look, we need to diversify beyond just stocks and bonds, especially in an environment where they're highly correlated, i.e. move together.
Excellent, excellent analysis, and so well said. We share similar mindsets. I also agree that the 60-40 has become just one asset class, and it's not really diversified. We need alternative investments, and no better timing than now. And you are there. Great timing on your part. You have all these wonderful ETFs and funds already set up with diversification across asset classes, as well as different, global countries. I mean, just amazing what you've set up. So I guess what I'd like to go into is, before we get into all that, is your entrepreneurship. You are an entrepreneur. You started out, you were an analyst, and then you were a CIO at Ross Smith Asset Management, where you managed a number of award-winning alternative investment strategies for, I think it was about a decade. Mm-hmm. And you're amazing what you've done over there. And then you go and you start your own. What was the catalyst? When did you decide, and why? What caused that? You know what? I'm going to go out on my own and I'm going to do it myself.
Yeah, that's a great question, and it's a path that many at least think about, and some go on and pursue. So just a quick career background. I came out of university, got recruited into investment banking, and I was super happy to start my career there, because getting an investment banking job coming out of college is typically very competitive, and it's a great place to start one's career. So I started at one of the big banks, largely doing mergers and acquisitions in the energy sector, so oil and gas producers, infrastructure, power, oil field services, etc. So I did that for a couple of years. My passion has always been on the investing side, and my goal was always to go to the buy side. I loved M&A. I love hedge funds, and so in the late 2000s, I started at a small firm where I cut my teeth doing closed-end fund arbitrage, and it's an interesting trade where you find a closed-end fund trading at a discount. You go and short all the underlying holdings, and closed-end funds on the Canadian market offer an annual redemption. So it's what I call one of those bulletproof arbitrages, where you can buy at a discount, short sell all the underlying holdings, and earn that spread into the redemption. And I still remember going through the global financial crisis, 08, 09, some of the arbitrage spreads available were just exceptional. I remember in the depths of the crisis, there's really no liquidity, and having capital to invest, we were, with some trades, getting, I believe, more than 100% annualized on basically these risk-free bulletproof arbitrage trades that we were running. And then from closed-end fund arbitrage, we expanded into merger arbitrage, convertible arbitrage. That market used to be highly inefficient in Canada. We used to make risk-free money trading convertible debentures while shorting the stock. But I believe that became much more efficient. We are doing volatility arbitrage, multi-factor long short investing, so all that stuff. Then I know you're interested in crypto. My story with crypto is I first noticed Bitcoin in 2013, and I wrote it off as something inconsequential, and then came back on my radar, and it started that bull run kind of after 2016. And I figured out this stuff's not going away. I should learn about it. And how I learn is by buying and trading in the market. So yes. Initially got invested in a Bitcoin in early 2017. And then after doing months of due diligence, I'm like, well, looks like there's something here. It's kind of birth of this new asset class that has tremendous potential upside, although highly risky and volatile. At the time, it was still very difficult to buy Bitcoin. there were Bitcoin ATMs. I remember at the time, there weren't really any Canadian exchanges. There was the Kraken exchange in the US that I wanted to use. And I remember having to mail a physical check to Japan, of all places, for it to show up on Kraken. And luckily it did several weeks later. And I started trading Bitcoin there. And I realized, it's this exciting new asset class. And I believe people want exposure to it. However, it's not only extremely difficult to get that exposure, but very difficult to keep it safe. People are always getting hacked, losing their keys and whatnot. So launched Canada's first crypto fund in 2017. And right as Bitcoin was going on a big bull run. I think we launched when it was around 2000. And then from there, so before SPACs were kind of a popular thing, I started a blank check company with the goal of merging with a crypto company, just because there weren't really any public crypto companies at the time. So that was kind of like my first entrepreneurial side project. And then in 2018, there was this upcoming huge regulatory change within the Canadian investment fund market that created something called liquid alternatives. They've had them in the US for a while. Basically, hedge funds, similar to a mutual fund, as opposed to a private limited partnership that were accessible to all investors, not just accredited investors, that were easy to buy and sell, i.e. liquid, transparent, and regulated. That market was just getting created and set to launch in 2019. So I thought it was a really good business opportunity to launch a firm 100% focused on this brand new market called liquid alternatives and what we were going to do. And at the time, I saw big growth in ETFs. And as I scoured the ETF market, there were no hedge fund ETFs. I'm like, well, here's this great asset class. And to give you a sense of one of my motivations is going through 2008, 2009, the hedge fund that I was working at, we had positive returns in each year. I think 2008, we were up, over 7%, 2009 up nearly 20%. And I looked at the stock indexes and they're down 40%. And a lot of investors really got burned there. What always frustrated me is, I didn't come from a wealthy family or anything like that. And after the global financial crisis, our clients from our fund were very happy and thankful. However, I always thought that, someone with $20 million, lost half their net worth, their lifestyle is not really going to change. They're still very wealthy. However, if, the average person heading into retirement with $500,000 lost half their net worth, then that would be devastating. And it would have a material effect on their lifestyle and their retirement. So I always thought, the people that needed these diversifiers the most, hedge funds, other alternatives that can actually lower volatility in their portfolio, do well when their traditional portfolio is doing poorly. They needed that the most. And for whatever reason, the regulators wouldn't allow them to access those. And not only that, but they're typically difficult to access, high fee, opaque, illiquid, etc. And fast forward kind of 10 years later, I launched Accelerate with the mission of democratizing alternative investments and bringing true institutional caliber hedge fund strategies, list them on an exchange, make them liquid, transparent, accessible, with no minimum investment, easy to use, one-click buy and sell, and low cost. And to me, that represented, a true democratization of the asset class and provide the tools for all investors, not just, $40 billion pension funds, to get that endowment style asset allocation. So started Accelerate. We launched our initial suite of investment solutions, alternative investment solutions, in 2019. And we're just approaching our 4-year anniversary of being in the market. So our most popular investment solutions would be arbitrage, multi-strategy, and absolute return, long short equity. So I can touch on any and all of those. But ultimately, what we're providing is diversification.
Absolutely, a much needed diversification across asset classes and alternative investment solutions. I have to say, hearing your story is so heartfelt, and your passion and that pioneering spirit to help others and to make the world a better place for people, because these weren't available to the retail investors, and you saw that need and you were the pioneer. You went out, you started those amazing ETFs and funds with, I'm impressed. Bitcoin in 2007, wow, 2017, amazing. And you had the goal of bringing it's the democratization, as you said, of alternative investments, democratization of alpha to these retail investors. Just amazing story. I love what you've built, and just admire your pioneering spirit. And that's what strikes me. And you're just a true creator. So honored to have you here. Thank you so much, Julian, for that amazing story. Very inspiring. I think we could begin with mergers and acquisitions. Always a topic that I found fascinating. Love it. And I think you have like 6 to 7 ETFs and funds. Is that right? Did I count right? I think I lost count after 5.
Yeah, we currently have 6, including 4 hedge fund ETFs. We have a eco-friendly Bitcoin ETF, and we have a private NFT fund.
Wow. Oh yeah, the NFTs. I can't wait to talk about that. So let's begin with mergers and acquisitions. What are the overall patterns that you're seeing with M&A into 2023?
Yeah, so it's a very dynamic environment. We're seeing a ton of activity, as we always do. So we're focused on North American mergers and acquisitions, of which for public M&A, there's typically anywhere between 60 to 90 M&A transactions outstanding at any one time. It's generally a mix between strategic acquisitions and mergers and leverage buyouts. The private equity industry has become a behemoth. They've raised like $1 trillion, and they got to put that money to work, largely by taking private, publicly traded US corporations. So we're seeing the private equity industry to be quite active, whether it's Blackstone or Apollo or Silver Lake. Firms like that are steadily announcing fairly significant buyouts. I'd be remiss if I didn't mention the largest buyout in history that closed just last year, the Twitter buyout by Elon Musk, $44 billion, which is by far a record. Just outstanding by him, because the record leveraged buyout wasn't even by an LBO firm, but an individual who's not even a professional investor. So it's very unique. And that was a very interesting situation. Then on the strategic side, you're seeing consolidation, large and small. One of the big deals right now is Microsoft Activision. We have a position in our arbitrage fund in Activision stock. Still trades at a pretty significant discount. You're seeing lots of consolidation in many different sectors. One very unique aspect that has occurred over the past year, rewind to 2022. As we know, the big story then was a rapid rise in interest rates. And that really changed the leverage buyout business. Number one, some of the banks underwriting loans for leverage buyouts got burned pretty badly. For example, whether it be on the loans for the Twitter buyout, or a tech company called Citrix, that was another large buyout. The banks who underwrote those loans lost hundreds of millions of dollars. So for a while, they stepped away from financing leveraged buyouts. So you saw private equity firms such as Thoma Bravo come in and either finance buyouts with 100% equity, which I believe was unprecedented at the time. So using no debt, we called that the unleveraged buyout, or credit funds, private credit funds really stepped in to take the place of banks in financing LBOs. That dynamic has somewhat reversed. We've seen banks, I guess, nurse their wounds and step back in to financing leveraged buyouts. We just saw a big one recently announced for Cvent, in addition to a few other recently announced leveraged buyouts. In addition to that, on the strategic side, I mean, technology continues to be active, healthcare, consumer, retail. You know, there isn't really any segment that is more popular than others. We haven't seen the expected consolidation in the resource sector, specifically energy and mining. However, I do expect that to increase in the future. So happy to delve into any of those, or how we play M&A as an investment strategy through arbitrage.
Absolutely, thank you. That was actually my next question: is are you seeing more activity in any specific industry or sector? It seems like you're seeing it across all sectors and industries. And my next question is going to be in that we'll definitely dive into the ARB fund of yours, the ARB, which is actually ranked number 7 globally. I was like, wow, this is amazing fund that you have. Are you noticing during these times that it's more of a buyer's market or a seller's market with these M&A? Are there companies that are distressed looking for people to acquire them, or they're going to fold? Or is it just companies on the other side saying, hey, I want to build during this bear market and let me find a good target? So where do you see which side?
Yeah, Rosanna, that's a very great point. We're seeing a bit of both. So one segment of the M&A market that we didn't talk about are SPAC, special purpose acquisition.
We're getting to that one next, but you can go into it.
Companies. So I'll save what I got on those. Aside from when a SPAC completes a merger, it basically changes into what we call a de-SPAC, or it converts into the private company that now turns public. Many unprofitable companies went public that way, and after the bear market effectively lost access to capital. So we have seen some distressed sales of de-SPACs that were their stocks down significantly, and I get the feeling that the board of directors didn't really have much choice in the matter. They kind of had to, we call it a mercy kill buyout. They basically had to throw in the towel and seek a buyer. Recently saw that with Berkshire Grey. They're getting acquired by SoftBank for well below $2 per share. I think it's around 58. We saw Volta get acquired by Shell for less than $1. And some other de-SPACs getting taken out just because they don't really have any other choices. And not only on the de-SPAC side, but other companies are definitely capitalizing. Large companies are capitalizing on some of the difficulties in technology or small cap space. Activision had well publicized issues, more so on the human resources side. They had some scandals there, so perhaps Microsoft was being a bit opportunistic there. Another one was iRobot, where Amazon is, attempting to acquire them, could have some antitrust issues on that one. So I see some of these very, jumbo cap or large cap entities swinging in opportunistically to buy probably very good assets, good brands on the cheap, because perhaps multiples have been smoked, or they've just lost access to capital and have to consider strategic alternatives. So we are definitely seeing opportunistic bids. Then we're seeing some private equity firms try to be opportunistic as well, and venture capital firms. I mentioned the SoftBank Berkshire Grey deal where they were already an investor, and we've seen some other private equity deals that way where, say the stock declines precipitously and they offer an attractive premium of 50, 60% on a stock that has declined dramatically. And that type of premium is fairly hard for a board of directors to say no to. But I'm sure behind the scenes, there's a lot of boards that even look at a high premium and the bid ask is still too wide, or they don't want to sell it at what could be the perceived lows.
Very nice. Thank you for that great explanation. Yeah, it's always what I think about when we talk about M&A. I'm interested in the sectors, and also, is it more of a buyer's or a seller's market? It seems to be a mix of everything. Very interesting stuff. I always talk about remaining liquid for opportunities, and it's important even for these companies with an increase, higher rates. There's a higher cost of debt and capital, and then you have a lot of these zombie companies. And all these companies that need a constant refinance to have capital, and it's at a higher cost. Margins are already compressed, and so they may be faced at some point with either they fold or they get acquired. And I recall in 2008 being in manufacturing. Since before that time period, our manufacturing business actually grew vertically and horizontally. We integrated both ways, and we seized opportunities. And I always tell people it's important to remain liquid to seize those opportunities. And when there were some distressed companies that helped increase our supply chain and also diversify our product offerings and services, we jumped at the opportunity. We were able to streamline our operations as well. So these are great times to build. And, and it seems that with this M&A, we're getting a lot of that. Funny, you mentioned Microsoft with the antitrust issues. I guess it's nothing new over there. We always have that discussion about Microsoft with Activision. Very interesting deals. And you wrote an excellent article about this, and you talked about the successful closings, how they're down significantly. I think it was in the 90s before COVID, and now it's about 82% or a little less than that. What's going on between the agreement of terms and the closing that's reducing the amount of closings?
Yeah, so the statistic that you're referring to is the implied probability of a merger closing as implied through the target share price. Like, I like to think of merger arbitrage in terms of probability of success. So say you have a stock trading at $90 and it strikes a friendly agreement to sell at $100. So naturally, the stock will trade up, but it won't trade to $100 because, number one, there's the cost of capital. Money's not free anymore. It's going to cost around 5%.
Mm-hmm.
And number two, there's the probability that the deal falls apart and the stock theoretically falls back to $90. So what merger arbitragers do is come bid up the stock, to which they find an attractive return if they were to get $100 per share when the deal closes at some estimated future date. So say in this example, they bid it up to $99 per share. The deal will close fairly shortly. So they're looking to earn that 1% return in, say, a month. So that's approximately 12% annualized, 1% in a month, which is a good return, right? And if we look at where the stock is at $99, if it closes, you get 100. If it falls apart, you get 90, assuming it falls back down to where it was trading pre-deal. So 1 up, 9 down. That gives you the probability of success implied by the share price of roughly 90% of the deal closing, 10% of the deal falling apart, and the stock trading back down. successful close, you get the $100 per share, and you make that profit as an arbitrager. So historically, U.S. public M&A has had a closing rate of approximately 94%, which is fairly high. And the way that arbitragers make money is, on average, they buy a portfolio of arbitrage opportunities below that and generate a return by investing in those arbitrage spreads. So pre-COVID, the implied closing rate was about 91%. Now, fast forward, post-COVID and today, it's widened out pretty dramatically. It's currently sitting around 82% implied chance of closing. And that's due to two things. So number one, interest rates went up. So you need to account for the time value of money, i.e. the discounting factor will basically force arbitrageurs to bid a bit lower than where they used to. Like, say, for example, 5 years ago, on that example that we had being taken out at 100, you could bid 99. Your cost of capital went up and you need a higher arbitrage yield, then perhaps you'd bid 98 to generate a higher spread and a higher return to account for your higher cost of capital. So that same spread, if it's now 2 up, 8 down, that's an 80% chance of success, or a 20% odds of failure. So that's one factor, but the major presiding factor is more aggressive antitrust regulators, both in the US with the Federal Trade Commission, the FTC, and the Department of Justice, the DOJ. They've both been fairly active. Granted, at this point, I believe they've lost more cases than they've won. Nonetheless, that hasn't stopped them from challenging deals, and internationally as well. One negative aspect amongst many when Brexit happened is that the United Kingdom now has its own antitrust regulator, the UK Capital Markets Authority. They want to make their voice heard. You have the European Commission. You have China's, it's called SAMR, S-A-M-R, their own antitrust regulator, the Competition Bureau in Canada. And for very large deals, they typically require clearance from all these different global antitrust regulators, even some smaller ones like Italy and Turkey and Saudi Arabia and so on and so forth. So that's been a major, not necessarily deterrent. However, it has led to deals taking a lot longer than they used to close. So you have more of that time value of money effect. And it just adds to that risk premium. So with the current regulatory environment, I feel like risk premiums have expanded. That being said, we really haven't seen an increase in the deal termination rate. So that's to be seen. It's something that we're monitoring, but hasn't manifested itself, even though the market's expecting it. Pricing spreads wider, implied probabilities lower, requiring an extra risk premium, i.e. higher returns, to participate as an arbitrage in many of these M&A deals.
Great, thank you. Yeah, I think challenges bring forth opportunities, and you're certainly finding those opportunities with these M&A activities that's going on during our time period. It's a balance. It's always a trade-off, and is a balance between increased regulation, and then you have antitrust laws that want to prevent monopolies from occurring. And before we go on, I have to ask you about the banking industry. We know there's been consolidation going on since the 70s, more branches, less banks. Do you foresee, being in M&A, do you foresee more banking consolidation going on from small to large, and maybe having a banking oligopoly?
Oh, certainly, and that's a trend that's been going on for like 100 years in the US. I've seen a long-term chart of banks outstanding in America, and just roughly off the top of my head, I believe the number of banks went from like 30,000 to 5,000 over the past several decades. And I definitely expect that to continue. The current banking crisis is certainly going to accelerate that, no question. And if you look up north to Canada, the banking sector is highly concentrated. There's like the big 5 banks, and then you have some credit unions, but it's dominated by basically 5 main players. And I think over time, ultimately, the US will get there as well. JP Morgan, Bank of America, Citi, and maybe a handful of others that just gobble up the whole industry. So there's going to be more and more consolidation there. And the really unique dynamic that the banking crisis caused, in which the strong got stronger. You have seen this deposit flight from smaller, vulnerable financial institutions to the big guys. No one's really concerned about JP Morgan going up.
That's my bank.
But they're
It has
concerned
been.
about First Republic going on. And what caused all of this is, well, the main thing was the rise in interest rates. If you look at what happened at Silicon Valley Bank, they had such a huge inflow of capital in the zero interest rate days, and they put a ton of it into fairly long duration treasuries and mortgage-backed securities. So as you know, the business of banking is to borrow short to lend long, and they did not effectively manage their interest rate risk at all. And they're quite vulnerable on the liability side to a rise in interest rates. So as interest rates went up, they suffered significant losses on their fixed income portfolio because they bought treasuries and mortgage-backed securities at very low interest rates. As rates went from like 2 to 5, then those bonds traded down, such that mark to market, I think they're down about $15 billion, which was basically equal to their equity value. So depositors realized that, and they're seemingly all buddies with each other. A lot of startups involved with the same venture capital firms that said, okay, looks like there's no more equity value left. Let's take out all our money. And there's a run on the bank, and that just creates a spiral where then everyone becomes concerned. If you're outlast out of the bank in a bank run, then there's nothing left. So whenever there's a rumored run on the bank, you want to be first, and that's effectively what happened at many of these vulnerable institutions. Silicon Valley Bank, Signature Bank, which we had a short position in our absolute return fund. And side note, it was our best short ever. So I think we returned negative 99.99% because we covered it at 12 cents. But that's a whole nother story. And then getting back to the initial question is these dynamics have made the banking business very difficult these days. High short-term interest rates. The other dynamic that makes it very difficult is an inverted yield curve, where the Fed funds rate is significantly higher than 2-year yields, 5-year yields, 10-year yields, and so on. So that really blows up the banking business of borrowing short to lend long. And with that, with such high money market rates, depositors are fleeing. Why keep cash 0% yielding account at a bank when you can get north of 400 basis points in a money market fund or treasury bills, right? And so you've seen tons and tons of money leaving banks and going into money market funds, and that's a trend that's going to continue. And people say, well, how's that going to stop? It's relatively, I'd say simple but not easy, as Charlie Munger would
I love that term. I always say that. It's simple but not easy.
It's simple point being banks just need to increase their deposit rates. The part that's not easy about that is it crushes their profitability.
Mm-hmm.
It's a tough balance, but they need to do something before what happened to Silicon Valley Bank happens to them.
Absolutely. Thank you so much. Amazing. Your wealth of information. In my opinion, this is a banking crisis is a symptom of all the free money, negative rates, and, QE changed the perception of risk. And it's unfortunate, but, that's where we're at right now. Silicon Valley is getting acquired by First Citizen. And now First Citizen will be a top 15 bank in the US. Have you had time to look at that deal? And if you have, what are your thoughts? It seems that they got a pretty good price on that one. What are you thinking?
Yeah, I've spent a very brief amount of time on that one. It's not, a typical merger arbitrage play, given the shareholders are getting diddly squat.
Yeah.
On the Silicon Valley Bank side, and another one we could touch on is Credit Suisse UBS, because the very interesting aspect of that one is while the bank was effectively insolvent and had to be bailed out by the government, equity holders are getting $3 billion at Credit Suisse. But I digress. On the initial consolidation that you mentioned, the assets of Silicon Valley Bank, is that it was heavily backstopped by the government, and the acquirer has a history of buying distressed financial institutions. So I feel like that type of acquisition requires a fairly unique specialty in buying distressed financial institutions. And obviously, if you look at the share price, the market loved it. It appears like you're getting a tremendous deal, but unfortunately, it comes somewhat at the expense of the taxpayer with respect to what the FDIC gets stuck with in terms of assets. The acquirer got to sort of cherry pick assets from the target, or should I say the FDIC that they took over from the target. And with that, it seems like they will make off pretty well, cherry picking the best assets with some risk protection from the government.
Thank you for that. Now, you had mentioned that this banking crisis could definitely happen to other banks. And we've been reading that commercial real estate, as well as the auto lending industry with Ali Bank right at its center, could be the next to be at risk. What are your thoughts? And are you looking to maybe any activity in those sectors?
It's really interesting that you mentioned commercial real estate, because there's so many different dynamics on there. We could talk for like all day about that. But
I used to be a commercial real estate broker with my own brokerage, so I find a very fascinating industry. So please talk.
Yeah, so it's quite a few dynamics there. Some that I find interesting is, number one, the underlying asset performance. I posted a chart just this morning on my Twitter. The segments of commercial real estate over the past year down between 5 and 25%. Whether it's lodging or apartments down 21%.
And office
offices got crushed about 25%.
Yes.
And those are long-term challenged with respect to work from home, corporations looking to consolidate and downsize. And these post-COVID effects that seem long-term in nature, really devaluing what was commonly thought of as a fairly safe asset class in terms of office properties, but those have just been destroyed. And if you remember, Rosanna, real estate is typically a leveraged asset. And so if you have something that's down 25 that you levered, 4 to 1, put 25% down, then your equity is effectively wiped out. And when equity is wiped out, you tend to see impairment on the debt side of things. And that's where commercial real estate loans can really come under pressure. Commercial real estate mortgages. I'd be somewhat concerned on that. My larger concern is private REITs. So if we look at what
Yes.
happened in the public REIT sector, I think on average they're down 25 to 30% last year, matching what we're seeing on the private asset side. However, you read in the newspapers about these large private REITs that claim they're up in 2022, which in my opinion was just fantasy, marking to model instead of marking to market, and effectively lulling their investors into a false sense of low volatility and low risk, when meanwhile it's a very high risk, high volatile asset class that was declining precipitously. So I think that there's more pain to come on the private side, because real estate, through the zero interest rate policy environment, they're partying, drinking the Kool-Aid. 2022 happened, rates rose significantly, and real estate is generally valued off capitalization rates, cap rates, which are a spread on interest rates. So cap rates went up. That means real estate values went down. And after the party, the hangover set in. It seems like many on the private REIT side are still trying to party and trying to stave off that hangover, but they can't fight the market forever. They're being flooded by redemptions, and they could have their own bank run. That's why people want to get out when the net asset values are perhaps marked artificially high, because if they don't mark them down, then there could be significant pain in the future as their asset values have declined precipitously, as we're seeing both on the public REIT side and then in the underlying asset valuations as well. So a lot of interesting dynamics on the commercial real estate side, and I think we're still early on that. I don't think you want to be a hero and step in and start.
No, I think there's also more pain to come, in my opinion.
Yeah.
They talk about, people are locked in at lower rates. Well, commercial real estate loans tend to be shorter term than, residential. So you have that factor, but you also have like office. Office has been on a decline. People work from home, and there's an increase in vacancies. And at some point, it doesn't matter if they're locked in at low rates, whether it's housing or commercial real estate. If you have vacancies, how are you going to meet your debt service? And then also with the housing market, we'll go over to the residential side. I know it's historical low inventory in our area here. And overall, except for the COVID hotbeds, you have low inventory. But if the layoffs continue and people are out of work, I don't care if you're at a 0% interest, how are you going to make that payment? So there's all those other factors. So I agree with you. I think that there's still pain to come, and remaining liquid to seize these opportunities and be ready, because there could be some distressed, opportunities there, for sure. Thank you so much for your excellent discussion.
Yeah,
yes.
one additional point is on the private side. I think that maybe the market, and I don't follow this market too closely, so this is just kind of like cursory view, is that cap rates haven't really adjusted there. However, on the public REIT side, there's a much more rapid repricing. So if you're going to be opportunistic on the real estate side, as far as what I've seen, it appears like you can get much better valuations in the public markets in terms of REITs than on the private.
Absolutely. And regarding REITs, I mean, they're more liquid than real property. So it's that thing you mentioned about liquid versus illiquid assets. So you have that. And then there's the DPP. Are you involved with any of that? Am I saying it right? I always get it as DPP. And do you do any of those type of investments with real estate?
No, we don't really do much on the real estate side at all.
Okay, good. Well, that's great during these challenging times, for sure. You mentioned a great point in your article, and I love your writings on Medium. I think everyone should check you out on there, Julian. You go right to the point, and you discuss all these issues in depthly, but yet so concise. You said that success as an arbitrager involves the deals that you did not invest in. Could you explain that phenomenon, please? I thought it was an interesting line that you used.
Yeah, and so to continue with my previous discussion on a more significant presence of antitrust regulators these days. Not just that, but regulators in other industries. For example, on the utility side, you got to deal with state public utility commission approvals. On the banking side, my God, doing a bank merger these days, unless it's supported by the government, it's very difficult to get approval. One that we're monitoring these days, and that comment is, the deals that you stay away from. I was just looking at First Horizon, FHN, which struck a deal to be acquired by TD at about $25 per share, and then the banking crisis hit, and it traded down to 15. And it looks like, the most probable aspect now is perhaps it'll get repriced, or TD will do whatever they can to get out of it, which within the context of a definitive merger agreement is not easy to do. I remember during the whole Twitter Elon Musk saga, those that weren't steeped in the M&A world and have experience in mergers and acquisitions is, once an acquirer signs a definitive merger agreement, a DMA those are typically airtight. So to get out of it, you just cannot, quote, walk away. The only way to get out of a merger agreement is if condition can't be satisfied. So that could be, shareholders vote against it, or a regulator refuses to clear it, or blocks it, or sues to block it, or whatever. Those are generally the only ways you can get out of a deal. So my comment with respect to that, the deal's not done, that's more so staying away from
the hairy ones.
Areas, yes, where the regulators are going to remain laser focused. What's that? Large consolidation, where there's two major competitors. The regulators, specifically the FTC, are very anti-big tech. Like, for example, they absolutely hate Facebook, or I should say Meta and Amazon. So it'll be very interesting to see how Amazon's proposed acquisition of iRobot plays out. So it's really staying away from kind of the difficult consolidation plays, unless you have some sort of edge, or if the regulators just has an axe to grind and is completely wrong. But and looking at the ones that could be problematic, and then waiting for the spread to blow and then get involved. For example, on that one, could have been like Twitter, or Twitter was less regulatory and more so a pretty wild buyer. Then on Activision, the spread started out fairly tight and then widened as it increasingly felt regulatory pressure, but then at some point became a buy. So it's also, like you said, staying away from the hairy ones, or at least getting compensated for participating.
Exactly. It's a trade-off.
A high spread and high good implied odds that are in your favor.
Love it. Yeah, you stay away from the high yielding problematic deals. I think it's always a trade-off. Does it cost you your peace? And I think you actually use the word return on brain damage in your article. I thought that was very funny. And I always say that it's like a return on your time and, your peace of mind. Is it really worth it? It may be like it's not realized loss on paper, but it is an unrealized, but it's really a loss on your mind and your time and your peace. So
if you think about what Warren Buffett often says, he talks about those 1 foot hurdles that he has to step over instead of the enormously difficult ones that you have to put all this energy into jumping over. And there's the notion of the too hard pile, and some M&A deals, you just throw in the too hard pile because it's very tough to handicap the odds of what the regulators are going to do on that type of transaction. And specific segments in M&A, I just like staying away from. Healthcare excluding pharma and biotech, banking and utilities.
Hmm.
Those seem to be the most difficult ones. Media, you saw some deals there going through some big difficulties. So it just helps to have the experience to know where to stay away.
Love that. You have a clear focus. You know what to avoid and where to focus your energies on. And that's exactly where our next topic is going, to SPACs. And we're going to talk about ARB, which is your arbitrage fund. And as I said before, number 7 globally. Wow. And your effective yield is 11%. Very impressive when you have junk bonds at about 8.8%. So love to talk about that. And one key term, SPACs are not dead. And let me tell you, I think to most people after the 2020 to 21 whole SPAC craze, people aren't looking at SPACs anymore. However, you are, and you have this ETF for SPACs. Please tell us about SPACs in 2023. What is going on?
Yes, so there's a lot still going on, despite what the media would tell you with respect to SPACs, which certainly had a huge boom and subsequent, could call it a bust, could call it a slowdown. But to put it in a context, if we rewind back to 2019, at the time, late 19, early 2020, the whole SPAC segment was roughly $20 billion in aggregate market capitalization across 99 special purpose acquisition companies in the market. And then post-COVID, things just really took off in a way that I did not expect. So I've been involved in SPACs for many years, and we launched our Accelerate Arbitrage Fund in early April 2020. So 3 years ago, basically. And our mandate was to invest in SPAC and merger arbitrage. So no one really knew what a SPAC was back then.
Your timing is, I have to say, you have great timing. I mean, what a great time to launch it. That's awesome.
Sometimes yes, sometimes no. I did launch a business right before COVID hit. So that was...
So you had one miss. Okay.
And so launching the ARB fund in April 2020 to focus on SPACs and M&A. At the time, the SPAC market, and it had been for many years, a real backwater, where there's a limited number of issues. And then I think what changed, obviously spurred by zero interest rates, was Chaff. So he had a SPAC, and it was coming up on its deadline. The SPAC has 2 years to get a deal done. And I think he's kind of scrambling, and he struck a deal with Virgin Galactic, which was SPCE, space. Like, oh, well.
I invested in that one.
Yeah, and I'm like, oh, this is probably going to end the way that many de-SPACs do, and not pretty. And then out of nowhere, it just took off, like off to the races. And this was a highly speculative company.
It was that substantial upside optionality, right?
Yeah, and we'll get into that. With respect to the target company, Virgin Galactic, not only did it have no profit, but it had no revenue and didn't forecast revenue for many years. And the major misconception before this was that public market investors only want to see profitable companies with consistent quarterly revenue growth, not these speculative venture capital type opportunities. But the Virgin Galactic deal turned that on its head. It's like investors, specifically retail investors in the public markets, were very hungry for these venture capital type high upside speculative investment opportunities. And after that, the race was on to launch SPACs. They're very easy to launch. And then back at that point in time, you IPO SPAC at $10. Firms like mine buy in the IPO because it's very attractive. Why we can get into. And then they announce a deal and it goes up, 50% overnight. You go from $10 to $15 with that tremendous upside optionality because investors were so keen on that new investment opportunity. However, with the bear market, those speculative type plays really did poorly, and that caused a cast of quite the shadow over the D-SPAC and related the SPAC segment. The fact is, like, way too many SPACs launched. They peaked at 721 outstanding in early 2022. And we went from, $1 billion in SPAC issuance per month to more than 30 billion back when, Ackman launched a $4 billion SPAC, Churchill Capital launching $1 billion SPACs, and the market ballooned to over 200 billion. So it went up over 10x in like under 3 years.
Wow.
Right.
I know. And then Shamat, you can't forget Shamat and SoFi. Wow, remember that whole time period?
And he launched like half a dozen SPACs.
Yeah.
So there were just way too many in the market, and they only have a limited amount of time to do a deal. And the way that a SPAC works is they raise capital from investors like our Arbitrage fund. We buy in at $10 per share. We get the SPAC shares plus warrants, sometimes.
We buy the units?
Yeah, so we buy the units at $10 in the IPO, which from my calculation, if you read my latest post, I calculate we expect to generate a return of between 6 to 10% annualized. And it's a very low risk, because if they don't get a deal done, we get paid back, our cash plus interest. So we tend to make money in all the scenarios. And then if a Virgin Galactic type deal happens, we can sell significantly higher, $15, $20 per share. I remember we own CCIV, that Churchill Capital SPAC, that merchant.
Churchill, yeah.
And we sold a bunch of it over $60 per share after buying it at $10 and monetizing the warrants at some absurd price. So the SPAC market these days, it's shrunk. There's approximately 400 something odd SPACs outstanding, about 450 last time I checked. Aggregate market capitalization below 90 billion. So it's down by not quite 2/3. The number of firms participating has declined dramatically. However, IPOs are still active. There's been about a dozen SPAC IPOs year to date. They seem more popular than traditional IPOs. Our fund has participated in the majority of those IPOs. So we're still buying these. We're still active. They're still very attractive. And business combinations are still being announced. So it's just that we went from like backwater to front page news. It'll probably go to backwater again. It's certainly probably still way oversupplied. But in the future, we'll reach a point where the market's balanced and things will kind of get back to where they were in terms of the SPAC market. And that's probably, maybe 50 SPACs outstanding. So it still has a long way to go. No,
yeah,
$5,200.
I love how you actually mentioned it. If it's probably overpriced, there's probably an opportunity there, and you've certainly found those opportunities. SPACs can be very smart, and I love the yield, how you calculate the yield. There's the income of the T-bills, which is about 4.5%, and also the discount to NAV. And I want to mention this, and I know you agree with this one. There's a higher interest rates is a double-edged sword. I mean, or I don't know if that's the right term. It works both ways. So when I get a loan, I'm going to be paying higher, but at the same time, my money in these money markets is getting a higher return than it was, 2 years, a year ago, or so forth. So these SPACs now are getting income from these T-bills. And so at about 4.5%. So you're getting, like you said, that 6 to 10% yield. I mean, it's almost like, oh my gosh, like, why didn't everyone think of this? It's so obvious and so smart of you to go when people are looking the other way, you say, there's an opportunity here, and you found it. And then I love that substantial upside that we talk about, like you said, with Space, SPCE with Virgin Galactic, and then Lucid Motors. You actually mentioned that in your article. There was Shamat's SoFi, there was that Sniper, there was Tortoise, let's see, Nikola, and Clover, Bark, Hims, Open. And I was invested in so many of these. I was a spec trader back in that time period. Fisker was another one. It was SPAQ. I remember that company. And then you had, was it Ride Now? And there's all those the EVs. There was a big EV craze. Are you seeing a substantial upside in this market like we had back then? Or is it much, much less?
No, there's like that upside optionality. We went from every deal having this, SPAC pop where it trades way above NAV, to like none. The sentiment's too bad, and we're still in like an equity bear market. So we have yet to see that return, and there's just too many SPACs outstanding. So is it dead forever? No. It'll come back at some point. When that does, who knows? What we are seeing is that SPACs go through the key aspect of the low risk nature of them, as long as you buy them at the right price, i.e. below NAV, is either whenever they want to do something like merge with the target, they put it up to a shareholder vote. And on that vote, they allow you to redeem your shares for the $10 plus accrued interest, which is, one generator of return. And with that, some of them have had very high redemption rates. And that creates these low float situations where some retail speculators come in and bid them up. So we have seen that dynamic, although we're not involved in that at all. It's just kind of a weird quirk of the market that's happening. But, those SPAC pops like you saw on like Churchill Lucid or Digital World and Trump's.
DWAC.
I don't think we'll see those again, but at some point, or in the current market environment, sentiment's really poor, so we're effectively seeing the baby get thrown out with the bathwater. However, in a better market environment with a less oversupplied SPAC market, we will see the market begin to discern between the good and the bad deals, and the good deals will once again trade up.
Yeah, great, thanks. Now, are you noticing that although we have less deals, that they tend to be better deals? Are you noticing that phenomenon? Because we had that huge increase in 2021, early 2021, and there were a lot of not so great ones. Are you noticing less is getting better?
No, I'd actually say the opposite. It seems to be getting worse because many SPACs launched in the spring of 2021 with a 2-year deadline. So many sponsors are kind of scrambling to get any deal done before they have to liquidate without a deal. So you're seeing some desperation moves. With that, some really low quality deals being announced, but not all of them. We are seeing some very interesting transactions being announced, and in my opinion, some very attractive ones. However, unfortunately, still seeing quite a few very low quality business combinations announced as well. So it's a mix.
Interesting. A mix. A lot of mixes out there, but definitely have that downside protection combined with the upside optionality. So very smart. I love that. ARB. Now, I think I'd like to go into your Bitcoin. I think it's called the Carbon Negative Bitcoin ETF. And, lately Bitcoin has held pretty strongly, and it has broken away from the rest of crypto. And it's holding, I think, the 28 to 29,000 level right around there. Of course, it can change tomorrow. Do you believe that Bitcoin is now demonstrating qualities of holding value, maybe against inflation, and possibly as an alternative currency?
Yeah, it's a really great point. So some of the things that I like about Bitcoin is the limited supply.
The inelastic supply.
Yeah, so 21 million Bitcoins outstanding, programmed on the blockchain, and with that, you compare it to fiat currencies where the money supply is increasing.
Printing, printing, printing.
Yeah, and so I think that that is a very good characteristic when you think of hard money. In my opinion, the main cause of inflation is money printing.
Yes, exactly.
So that will continue to be an issue. And then, in addition, Bitcoin had many major technological innovations in terms of a native internet money, call it. And it enabled self-sovereignty for investors. Basically, the first time ever outside of, holding a brick of gold and some diamonds and a watch in a safe somewhere, which is notoriously difficult to transport if necessary, and even more difficult to send halfway across the world. With Bitcoin, you can do that all electronically. So to create a hard digital money was a huge innovation, in my opinion. And when people complain, oh, Bitcoin is speculative, it has no intrinsic value, it's like, well, what would you complain about Bitcoin? To me, it's like a godsend for investors because it has all these positive properties. And, if you don't want to own it, that's fine. I don't own every single thing out there. Some people see value in Rolex watches. I don't have one of those, but I can see why others would view those as valuable, or baseball cards, or whatever they are, or U.S. Treasury bonds. Granted, those now pay interest. But that being said, very innovative, tremendously useful for investors. And when I think about diversification and asset allocation, I do like to think about tail risk. And the way that I think about it differently is when generally people think about tail risk, they're worried about the downside. If everything goes bad, I want something that's like an insurance type payoff. However, you also need to think about tail risk to the upside. If things get really bad on fiat currencies, and then, I own two assets to protect myself in that scenario, Bitcoin and also gold. I think those help protect investors, and they should be at least a small part of a portfolio. They serve their purpose. Those are the true hard money, in my opinion, both gold and Bitcoin. They're generally uncorrelated with the market, have good long-term historical returns, and I think good potential upside as well. The other common criticism I hear on Bitcoin, they're like, oh, it's too volatile, too risky. Well, the way that you deal with volatility and risk is not to just say no. The way that you deal with volatility and risk is to have appropriate position size, right? If you think stocks, 10% of your portfolio in stocks, and 90% cash, I'd say that's low risk. However, if you have 300% of your portfolio in stocks, that's very high risk. You have 300% of your portfolio in, 2-year treasuries, that's still very high risk. But if you have 100% of your portfolio in 2-year treasuries, that's much, much lower risk. So
exactly.
Position sizing is how you appropriately deal with risk. So that's how you deal with, gold, Bitcoin, things of that nature. They're uncorrelated, great track record within portfolios, great potential upside, and serve really to protect investors. Number one, financially, as these upside tail risk hedges. And number two, that self-sovereignty of having financial assets outside of the purview of the government. I don't know about you, but like if the government came to me and said, oh, we're going to put a camera in every room of your house and we're going to watch everything you do. Like, I'm not necessarily doing anything wrong, but I don't want the government spying on everything.
Agree.
You can use the same analogy for financial transactions. Do you think that the government should have, know everything that they can about your financial situation. If you don't want that to be the case, then Bitcoin, gold, other collectibles provide a great solution. And the thing that makes Bitcoin great is it's all digital. So I think a form of internet money that helps an investor be truly self-sovereign is just a tremendous tool for an investor to have. And that's the type of thing that should be celebrated.
Absolutely. I love that. You're such a forward thinker and agree with you completely. I don't do anything wrong.
Can I caveat that, Rosanna? One thing is, yes, I'm bullish. However, I am cognizant that it's a highly speculative and risky asset. So I always advise, play it safe, allocate a low single-digit % of your portfolio, Bitcoin and crypto, and definitely keep it below 5%, because I see people getting way over their skis, taking on way too much risk. So if you're, a moderate investor that wants to be diversified in your portfolio, think about Bitcoin as 1% and gold as 1%. I think that's still great. If Bitcoin goes up 10x, you get to enjoy that. If it drops 90%, you're not crying too much about it.
It's always about risk-adjusted returns. Yeah. And so we have to always factor in our risk. And reduced position sizing is key to help reduce risk, as well as reducing the reactions associated with emotions. Emotions are normal, it's natural, we're humans, we all have emotions. However, we want to limit that impulsiveness or reaction. And the way to heighten those emotions and to get that reaction is by being overly exposed to risk. So I sleep a lot better at night having reduced position sizing and diversification across asset classes. I just love your mindset and a great explanation of the sovereignty, the importance of sovereignty. And, we don't do anything wrong in our home, but we don't want to have cameras watching our every move. I agree with that completely. At the same time, do you believe with all that's going on, and I also agree inflation is about too much money chasing too few goods and services. It's about the largest increase in money supply we've had in decades. And that's what direct cause of inflation is. Everyone's looking at rates, and we got to look at the money supply. And so do you think we're undergoing the debasement of fiat currency?
Yeah, that's a great question. And from an economic standpoint, I'm no economist, I'm an investor, entrepreneur, etc., and a fanatic about markets. And in terms of being an economic maximalist, I'm a huge fan of Milton Friedman, legendary economist. And I'll paraphrase him, but he said, inflation is and always will be produced in Washington, i.e. the government. The government creates inflation. That's the only thing creating inflation. And if they tell you otherwise, they're just trying to cover up the inflation that they cause. So massive government spending, you're going to get inflation. Huge increase in M2, huge increase in the Fed's balance sheet. So it's no surprise that we're having significant inflation. And what inflation in its very most basic definition is just reduction in purchasing power of dollars, of paper money, fiat money. And so the fiat money experiment, and many people don't pay attention to history, but or those that criticize Bitcoin for not being backed by anything. Well, fiat currencies, dollars, they're not backed by anything either. And that notion is very new. It's
excellent point.
It's only been that way for like a small fraction of human existence, 50 years. Meanwhile, prior to that, money was precious metals, right? It was backed by something tangible that couldn't be printed by governments. Certainly, they would try to debase it by taking out, replacing it with lesser metals, making the coin smaller, way less, etc. We used to have a silver dollar, and then dollars turned to paper. And the way that money got created, where they were basically IOUs on precious metals, typically gold, held in banks. And it just became a lot easier to trade those IOUs than it was to trade the gold. But those IOUs were always backed by gold. And now IOUs in the form of fiat currency, they're not backed by anything, except the full faith of the government. But that being said, you look at inflation, and over a generation, you can expect that, at 2 to 3% inflation rate, $1 will lose 95% of its purchasing power, effectively become worthless over less than 100 years. So that is something that will continue to occur. If you listen to what the government tells you, they target an inflation rate of 2%. That effectively guarantees that the dollar is going to become worthless over 100 years, right? And so I don't think that math is too difficult to figure out. If you're just holding dollar bills on your mattress, you're going to do very, very poorly. You invested in short-term T-bills. Right now, the real return is negative. But I think historically, the real return has actually been positive, whether it's 0.5% to 1.5% in that range. So you'll stay above inflation on average over the long term in treasury bills and in fixed income on average. But that being said, yes, fiat currency will continue to lose their value, and what will do well in those scenarios is income generating assets, equities, land, farmland, real estate, and then store of value assets, gold, Bitcoin. So, I like all those. And that's why, you're preaching to the choir, Rosanna.
Yes, we're preaching to each other here. I love that.
The message of diversification. And one of the main things that seems to be very misjudged by the average individual and even the average investor is whenever they talk about de-risking, they say, I'll go to cash. But over the long term, cash is perhaps your highest risk asset because you're effectively guaranteed to lose almost all its purchasing power over the long term. So if you want to de-risk and have a much safer portfolio, don't hold cash. Certainly hold short-term liquidity, but a long-term cash allocation is a losing proposition. The better play, the safer play, in my opinion, over the long term is diversification in terms of holding at least 6 uncorrelated asset classes.
Yes, and we're going to get to that next, actually, going into your one choice alternative portfolio. I love that one. I love the different assets. I love how you speak about the different asset classes and you have them classified. But before we get to that, we can't leave the crypto world just yet. I have to get you with one more, the NFTs. But before we get to that, I want to talk about that great point that you made. There's a big argument against Bitcoin and crypto saying it's not backed by anything. There's no value there. Well, like you said, fiat currency isn't backed by anything either. And so I love that point that you made. Thank you so much, Julian. As a CFA, you've explained that very well. So you don't have to be an economist. You explained it actually perfectly well. So thank you so much for your response to that question. So NFTs, non-fungible tokens. I also say non-fungible things. And you created a fund on that. What was the thinking behind that? You were also a forward thinker with that.
Yeah, and it really was established out of our work on the cryptocurrency side. So just to kind of caveat my bullishness on Bitcoin and I'd say select NFTs is I think probably over time, 99% of cryptos and NFTs will probably go to zero. On the crypto side, I say just stick with Bitcoin and Ethereum. That's all you need. You don't need to play around with these other ones. Ultimately, it's ones with the largest network effects. that will do well over time, and the others will sort of fade off into the sunset and slowly go to zero. So just kind of focus in those areas. They're risky enough. And then on the NFT side, so I initially noticed NFTs, I believe it was in 2016 with the launch of the CryptoKitties on the Ethereum blockchain. I'm like, wow, this is a pretty unique and novel use of the technology. But again, these will be inconsequential and kind of making the same mistake that I made with Bitcoin in 2013. And then in 2020, I started seeing NFTs become more popular with NBA Top Shots and other Ethereum-based NFTs. And I thought back about Bitcoin. I'm like, well, I don't want to make the same mistake again. I don't want to write this off. I think there's something here. And the way to learn about it is to start investing and trading in these markets. So I started getting into NFTs, I think early 2021. And then after studying a lot, buying NFTs, trading them for about 6 months, I got extremely bullish. I'm like, well, there's definitely something here that has massive potential upside. Kind of like this big light bulb went off. And I utilized not only the Bitcoin analogy, I viewed NFTs, over the past 2 years as where Bitcoin was in 2013, with the number of participants and potential upside. And since then, Bitcoin is basically like 50 to 100x as it became adopted globally. So NFTs were very, very early on their growth cycle. And then a couple other analogies. One is from the art and collectibles market, which has been an investable asset class for literally thousands of years. The only one older is perhaps gold. But people talk about stocks. Stocks are relatively new, been around for a few hundred years. But art and collectibles have been around for way longer than stocks as an investable asset class that has produced very, very good returns for investors. And if you talk about art and collectibles, it's like, a small fraction has generated all the returns, and over 99% are probably worthless, right? So if you focus on what we call the blue chips in the art world or the collectible market, you've done great. And if you think about what an NFT is, it could be, a PFP, like a profile picture, like the CryptoPunks or Bored Ape Yacht Club. Could be like digital art, like what you're seeing in the Fidenza, or what Damien Hirst is doing with the currency and all that. There's all these different art projects, Beeple, for example. You look at in the art market, whether it's a Basquiat or some of the other very renowned artists, Banksy, some of the older artists, Michelangelo, etc. Those have retained tremendous amount of value over time, right? Some of these art pieces are selling for, tens of millions of dollars, or $100 million. I believe, Koons has had some huge sales. You recently saw the sale of that. Was it Da Vinci, Salvatore Mundi, which was acquired for, I think, over $400 million by Mohammed bin Salman of Saudi Arabia. And they weren't even sure if it was legitimate and real. But that being said, if you look at art, it's been proven as a legitimate store of value over many, many years. Or even on the collectible side, Mickey Mantle rookie card, which is in effect just ink printed on a piece of cardboard that was obtained in a pack of bubble gum or whatever. It's now worth $5 million. That's just crazy. Now the thing about NFTs, if you use that art and collectible analogy, it just made it way better because it's digital, it's liquid. You can tell the provenance, like where they've traded. You can 100% assure that they're authentic. And we focus on these blue chip collections. that, in my opinion, for millennials specifically, those will be, the must-have art in 30 years, right? When, you have wealthy millennials that are retired and looking to collect art, they're not looking to collect, a physical picture
Yeah.
on the wall. They want, a CryptoPunk. And I think they'd be willing to pay millions of dollars for that. Because over time, media goes from physical to digital. We saw it in music, we saw it in movies, and now the Ethereum blockchain specifically has enabled the migration of art and collectibles onto the blockchain, which makes it, in my experience, much, much easier to invest in. It's more liquid, it's more transparent, and it's fun. I mean,
It
it's
is fun.
cool. And you can get airdrops, you can, and that's the other aspect is people really undervalue is the income producing potential of NFTs. Some of them is that they represent intellectual property, right? Many will airdrop highly valued additional NFTs just by way of owning one. So you can view it as being a membership of a club. If you own a Bored Ape Yacht Club, you're in the same club as Snoop Dogg and Eminem and Paris Hilton and Justin Bieber. And so it's a very kind of limited exclusive club. If you look at physical objects that people want to own for social proof, you'll look at, say, once again, the Rolex watch, or whether it's like a luxury automobile. If you own a Lamborghini, you generally buys you instant social proof. However, in the digital realm, those are worthless. In the digital realm, on the internet, which of course everyone uses these days, there's finally a way of establishing this social proof, and that's via NFTs. So that's a huge aspect to it. People like to floss and whatever, and it establishes not only social proof, but credibility if you own some of these. So with respect to that, we launched the Accelerate NFT Fund last year to invest in blue chip NFTs. I'm extremely bullish on them. I think they have 10x upside. However, certainly the most risky aspect of the portfolio, and they could definitely go to zero, or they could skyrocket. We'll see. But
Absolutely.
again, it's fun. It's like if you remember collecting hockey cards or whatever as a kid.
I collected baseball cards.
Yeah, baseball
I
cards.
still have them.
Yeah, and it's kind of the same thing. Comic books, NFTs are that, but for adults.
Exactly. Now you got me wanting to go look at my baseball cards. Maybe something is of value in there. I have it from the 80s. I have Topps, I have Don Russ, and I think it's some other one. But now you want me to, I'm gonna go look and see if I have a good card that has appreciated.
Yeah, maybe a Mickey Mantle.
I don't have that one. I didn't collect back then. I wasn't around back then, but like you said, it's very smart. I love your forward thinking. These millennials one day are not going to be looking to fill their mansions with artwork on their walls. And they're very minimal. They're minimalists nowadays. They're very efficient. They're more about experiences over purchasing, things and filling up these big spaces. It's about efficiency nowadays. And, I love studying generations. I'm part of Gen X. I'm a Gen Xer and a proud Gen Xer. And, you read about, my kids are Gen Z or millennials. So I love looking at trends, and that's part of the investment process. Ultimately, I'm an investor just like you, and I'm always looking for opportunities. And so yeah, great points that you make regarding digital artwork, and art trade has been around for hundreds of years, and people have been trading artwork. So I love that. And with the NFTs, there's NFT music, NFT royalties, and I've been studying about the minting process, and the smart contracts are just fascinating, the whole process of that. And then the exclusive clubs, like you mentioned, it's a community that you're building. And, the fans actually become part of the creation process. And it's like really cool. It's a very, very like interesting and fascinating concept nowadays, the
Yeah, and with that
NFTs.
community aspect, some people will pay $50,000 to join a country club, yet scoff at, you know, a $5,000 NFT. But to me, it's just another aspect of why you own an NFT as, you know, membership into an exclusive community, which
Exactly.
can ultimately be extremely lucrative.
Exactly. And you know what? You're probably going to use that much more than the country club. You know, I know a lot of people in my area here are members of country clubs, and how often do they really use it? Who has time nowadays? So, but that digital, you know, community that you have, you're probably going to be on it every day, like all the time, right? You know, just like we're on Twitter all the time, and that's how we met. Is your profile picture an NFT? No.
I have minted a couple NFTs, one of which was my profile picture. I recently changed it though.
Oh, okay. That's
So you
cool.
can check out my OpenSea profile. I think I have some
Yeah.
NFTs.
Oh, you're on OpenSea. I'm gonna have to check you out on OpenSea.
Yeah. So aside from the NFT fund, I'm an avid personal collector of NFTs as well.
Awesome.
I'm a big fan of digital art.
So you're not just the fun creator, but you're also a client, right? You have your own NFTs. Remind me
I
of
can never make money as an artist, so any ones that I've minted, I've just given away for free.
that. That's very cool. Thank you so much, Julian. So let's go into your one choice alternative portfolio. I love that. How it's a diversification across all asset classes, and you go into the 6 main asset classes, and absolute return, private credit, real assets, alternative currencies, gold and commodities, global macro, which I find very fascinating, the risk parity, and alternative equity. Please tell us all about that.
Yeah, so this is just a continuation of the discussion of, you know, not quite the decline of the 60-40 portfolio, but an improvement of the 60-40 portfolio, going towards more of an endowment style of asset allocation, diversifying beyond just stocks and bonds, which I believe is, call it the new balanced portfolio, where you have more than just 2 asset classes, which are really behaving like one asset class these days. Like I said, the goal to have 6 asset classes or more. And so we saw the proliferation of the 60-40 and the opportunity to improve on that. So the goal of one choice, 1C as we call it, is to augment the traditional portfolio and assist investors in getting them into the new balanced portfolio, which we consider a 50-30-20 allocation. So you got 50% stocks, 30% bonds, and a 20% sleeve of alternative investments. And that's where one choice comes in. You know, we handle all of the alternative investments in one easy to use one choice ETF.
Are these actively managed?
So we select the allocations right now. So there's 6 alternative asset classes, 10 alternative strategies, and we rebalance them, monitor and rebalance on a quarterly basis. So it does not follow an index. So I suppose that would be actively managed. However, we're not tactical in any way. And we're not, you know, trading it and making, you know, allocation decisions on the fly.
Got it. So no 0 DTE for you for your equities, right?
No, none of that. And ultimately, what we're trying to establish is a Yale endowment ETF, where you can have all the necessary alternative investments in a one ticket ETF that for an investor to do on their own would be like literally hundreds of hours of work. We just do it for them. Like the way that an analogy I use is if you want alternatives, like you wanted stocks, you're like, okay, I'm going to buy stocks. You could either just buy the S&P 500, or on the other hand, you could research and buy all 500 and something of the S&P 500. Right? And which would you rather do? What sounds easier? Just buy the S&P 500 and leave it like that.
I like that. ONEC. Awesome ETF there. And then that'll lead us to your equities, Hedge. That is your long-term equities, HDGE, which sounds like hedge fund. Tell us about that diversified portfolio, please.
Yeah, and so it's our absolute return fund. It's multi-factor long-short equity. And what that means is we're basically systematizing what a human portfolio manager would do. And we're focused on 5 main factors. So you may have heard of factor investing. There's a value index, for example, a value fund, a momentum fund. You've even heard of like quality focused ETFs, low volatility ETFs. These are all based on quantitative factors that have proven themselves to outperform over time. And they're all based on academic research that shows, hey, stocks with lower valuations or stocks with higher quality outperform higher valuations and lower quality, right? But these factor ETFs, they basically miss 2 things. So number one is that factors work better together as a composite than as a single factor, makes for a better return with low risk. And then the way that the academic research always looked at factors is both long and short. So I say that most ETFs do factor investing half-assed because they're only doing the long side and forgetting the short side. So our Hedge ETF, and as you indicated, Rosanna, it does, its goal is to serve as a portfolio hedge on the equity side. It's both long and short. So the way that works is every month, we sort and rank all 4,000 liquid North American stocks. And we sort that based off a 5-factor model. So we look at value, quality, price momentum, operating momentum, and trend. From the top decile of that ranking, we select the long portfolio, the ones we expect to outperform. And from the bottom decile, we select the short portfolio, the ones we expect to underperform. We go 110 long, 50 short, and it's created a profile that is slightly negatively correlated to the S&P 500, hence the Hedge ticker. For example, in March of 2020, when S&P dropped double digits, Hedge was actually up. And so it has that insurance type hedge aspect to it. But in addition, it has produced positive returns for investors. So when investors typically think of a portfolio hedge, the first thing that comes to mind is put options. But as you know, put options is an insurance-like product that costs money and will be a drag on returns over time. So we view Hedge as, and we ran the numbers, it's been around for almost 4 years. If paired with the S&P 500, it reduced the drawdown by about 50%. And when I say that, people will ask, well, how much did it cost on the return to get that drawdown reduction? Well, not only did it not cost, it actually added 2% per year of performance. So I like to view Hedge as portfolio protection that you get paid to own, basically like insurance. Imagine if you could have insurance that they pay you to have. I think that's a fairly good value proposition. It certainly doesn't work in every single environment. Like we had a difficult 2020. I remember talking to investors like, oh, 2020, easiest environment to make money. How did you lose in Hedge? Well, then I said, well, you said 2022 was a difficult environment. Hedge was up over 15%. But that's what you want to see from a diversifier, right? Something that can do well while your equities are doing poorly.
Absolutely.
So we're long, high quality, undervalued stocks that are doing great, and short junk stocks. In 2020, the junk stocks, the highly speculative names skyrocketed, which is why we did poorly. And in 2022, those really got slammed, whether it's Carvana or Nikola or Peloton or Open Door. Our model shorted all those names, and they're all down more than 80% last year. We were short Signature Bank, which went to almost zero. We shorted around 135 in our model, and we covered at approximately 12 cents. So it has a good track record of shorting the worst stocks and going along the best stocks. Obviously, no guarantees, but it's very unique in the marketplace in that it gives investors true long-short equity in an ETF.
I love that. I guess you were a little early for that shorting of those junk stocks, but you got it this past year.
Yep.
I always say fundamentals matter, and this new regime change that we're in right now, I think fundamentals matter more than ever. And I tend to be more of a fundamentalist. I'm a math person. I was a CFO for many years, and also an MBA. And, so I love the calculations, and I think it's important. It's great that we're returning to that. And, two key words from your hedge portfolio, what I love is diversified and risk adjusted returns. And that's so important. Your focus on investments and your CFA and all that comes together, because what's most important are risk-adjusted returns. And I love that diversification with your hedge fund. So thank you so much for explaining that. I think we'll hop over to the dollar. Just a quick question for you with the dollar. You made some excellent points earlier about that. Do you think the dollar, the US dollar, will remain as the global reserve currency, or you think it will be challenged in the near future?
That's a really good question. And when we're talking about dollars, we got to look at it versus every other currency, right?
Absolutely.
And as a global reserve currency, you got to see, okay, what has the best potential to be number one? Obviously, the US dollar is a top spot now and has had that for a while. And prior to that, is probably, the pound. And you look at the other alternatives, could it be the euro? I don't know. It seems like they're in a worse position economically.
Yeah, exactly. Their banking system, I think, is far worse than even the US.
Yeah, can it be the Japanese
yuan? Or the
yuan? Yeah, Chinese yuan. Like those are much more problematic than the US dollar, and other currencies just don't have the liquidity or the size. I think the dollar will remain king for the foreseeable future. Vis-a-vis other currencies, I just don't see any other taking its crown in any reasonable time frame. But that being said, I do like Bitcoin and gold as alternative currencies.
I love that, and they can all coexist. So absolutely,
exactly.
I love. Goes back to the beginning of our discussion when you talked about the correlation between TLT and QQQ. There's been a regime change. Agree with you completely. I also believe that the bond bull market, the 40-year bond market, bull market has ended. And I don't think it will continue. What are your thoughts? Do you think this correlation between TLT and QQQ is now going to be this way for this new regime?
Yeah, it's a great question and has major implications for asset allocators.
Absolutely.
Given, the historical reliance on bonds in terms of diversifying stock portfolio and their place in asset allocation. So with respect to correlations, like they've never been solidly one way or the other. So the notion that bonds are negatively correlated with stocks, it's just not, it has never been the case. Granted, before 2022, it had call it a good 10 years where they're probably averaged around negative 0.5 correlated. However, over the long term, they've been positively correlated more often than not. And that happens more often in an inflationary environment. So if you believe we're in an environment of higher for longer, which I believe.
I was just going to ask you, higher for longer?
Yes, I think that positive correlation between stocks and bonds it'll obviously oscillate, but that relationship will remain more positively correlated than anything else over the next several years, in my opinion, if not decade.
I agree with you. I think we're in the same camp, the higher for longer camp. I think that's what makes sense, and that's my opinion as well. So taking everything we discussed and throwing in the macro that we talked about sparingly throughout the whole discussion, you know, persistently elevated inflation, rising core month over month, low growth. We know we saw the GDP estimates come in even lower. I think it was like 3.6%. Now it came in at like maybe 1.6, something like that, was revised lower. We know earnings recession is probably all around us here. We know there's a decline. Margins are compressed. These are difficult times in the equities market and even private equity for businesses. It's a tough time for businesses overall. Me being in the business world, I saw it with 2008 and I'm seeing it. Not that the two times are the same, but you know, the bear market cycles have their human emotion element and we go through similar patterns. That's why people say it rhymes. So with all that stated, what are your thoughts, in your opinion, for this year, 2023, going into next year and further? And what type of recovery timeline do you think? And what do you think overall for the future?
That's a great question. Short-term forecasts are notoriously difficult, but I'll give it a shot. I would not want to be a bond investor. I think rates are going to be real choppy. And you're having this battle between where the Fed sees the Fed funds rate on the back half of the year and investors speculating on rate cuts. So where that ends up really depends on the cadence of CPI and PCE over the next several months, which is anyone's guess. If I were to take a stab at it in a battle between the Fed and the market, they always say don't fight the Fed. So I'd say the Fed wins with high rates, i.e. over 5% for the rest of the year, which is where the dot is these days. And with that, the implications for bond yields is, the decline has been perhaps somewhat premature, I'd say. And if you look at specifically where the 10-year is right now, what is it, around 3.4 or so?
Like that, yeah.
And if we look, historically, you want a risk premium over the Fed funds to go take that duration risk. Historically, I think that's been about 150 basis points.
Exactly, 1.5%.
And then the Fed funds rate, you want a real rate of return. So above inflation, that's call it been like 50 or 100 basis points. So you need on that 10-year, basically 200 basis points above inflation at a 3.5% of the 10-year. That's implying at inflation at 1.5%, which to me, I wouldn't be willing to underwrite that. Ergo, I believe the 10-year Treasury bond is a poor investment here. Could serve a purpose in diversified portfolios because ultimately, the purpose of diversification is we don't know the future.
Yes, the uncertainty.
In weighting of probabilities across the spectrum, I'd say underweight the 10-year bond, both short-term and long-term. And then stocks, I don't have, well, it's mixed and it's nuanced. So I think US equities will underperform both in the near and medium term. Valuations are just way higher than anywhere else. Doesn't even make any sense. Whether it's Canada, Europe, Japan, emerging markets, valuations are so much lower. So I think US will continue to underperform as it did last year. So with that, if you're going to invest in equities, definitely don't just buy US equities, allocate globally. That'll help significantly because the US went on a ridiculous run of outperformance, which resulted in massive differential in earnings multiples, which historically over the long term just hasn't been there. So I think you'll see some mean reversion on the stock side. And with respect to stocks, specifically US equities trading near 20 times earnings. So inverted, that's an earnings yield of about 5%. And now the Fed funds rate could be heading above 5%. So that equity risk premium is zero.
Yes, exactly. With the risk,
You're not really getting paid to take risk in equities. So at least in the US, earnings
Mhm.
yields are higher internationally. That being said, I think, yeah, you still want to own stocks in a portfolio, but definitely underweight the US and overweight other developed markets, Canada, Japan, um, Europe, and emerging markets as well. I wouldn't say I'm bullish on like China or Russia or ones like that. There's no
Exactly.
rule of law, but make sure
High
there's
risk.
countries, yeah, and you know, gain equity exposure to those that have lower valuations.
Absolutely. A Canadian who's pro-Canadian. I like that. I
Not
also
always.
like some Canadian
I look
companies.
at the numbers, and when
Exactly.
the U.S. is looking better, I'm pro U.S.
Exactly. I agree with you completely. I actually like quite a few Canadian companies. I'll just name one, Tech, TECK. I like that. They didn't get that takeover, so they went up significantly. Great company, natural resources, and they have a dividend as well.
Yeah, we're
You,
long of tech,
you
and
are.
yeah, it's an interesting point on the sector. I'd say lean towards lower valuation sectors,
Mhm.
energy, materials, industrials. Not too bullish on the banking side.
No.
Stay away from banks at this
I think the
point.
most shorted is that Dominion, right? The Toronto Dominion
Bank,
Bank.
yeah, 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 and then definitely underweight large cap tech, I think, and
Agreed.
unprofitable entities. I think those will continue to underperform as they did in 2022. Had a bounce back in 2023, but I think that's just temporary.
I think the market SPX is overpriced in my opinion. When you see the earnings yield less than the risk-free rate, both NASDAQ and SPX, it's expensive. And the equity risk premium, like you said, is zero. Why am I taking on risk when I can have a risk-free rate of about 4.5%? I need to be compensated to take on risks. Therefore, valuation should come down, price should come down, and fundamentals matter. So I look for the lower valuation plays as well. Great, excellent points that you make. The only certainty we have is uncertainty. So I appreciate you sharing your mindset and your thinking based on all your experience. There's so many moving parts and they're always moving and changing. So we never know. And that's why diversification is key. And across various alternative asset classes and also globally, like you said, excellent points. So I have to ask you, Julian, you have a lot of ETFs and funds. What are the future plans? Any more ETFs or funds that you have planned?
Yeah, it's a great point. So right now we're focused on growing our current suite of alternative investment solutions. We've been around for almost 4 years. We're really happy with what we have out in the market. So just trying to, increase their use in investor portfolios. I believe everyone should be properly diversified, and that's really our mission and what we're trying to accomplish. And we covered the main bases and where I think investors should be what they should be owning. So yeah, I think and if you want to keep it easy, then our one choice ETF, it handles all that for you. You get
I love that.
all your bases covered on the alternative side.
Awesome. So that's what I was going to ask you. How can people stay in touch with you? I know accelerateshares.com is your website. And then your tickers are on which exchanges? Could you please share
so
that
they're
with us?
on the Toronto Stock Exchange, the TSX.
Okay, perfect. Awesome.
Yeah, and you can follow me on Twitter at Julian Klymochko. And if I could leave your viewers with a few of my favorite quotes.
Please do share with us.
Yeah, and I don't have them in front of me, so this may be a bit of paraphrasing. But
that's okay.
First one's from Warren Buffett. He said, teach a man to fish, feed him for a day. Teach a man to arbitrage, you feed him forever.
Love
So
that.
that's probably my favorite one. The other one, price is what you pay, value is what you get. That might have been attributed to Ben Graham. And then one of my favorites from Howard Marks. He once said that it's not what you own that determines investment success, but how much you pay.
I love that. And I'll add to that as well, having been in commercial real estate and starting my career in real estate investments, I always say it's about what you pay. And that's when you make your money. It's when you buy. And that goes in line with that last quote that you just said. Thank you so much for taking the time to share your brilliance with us. I have to tell you, I really enjoyed this, Julian. You're so smart, and your entire thesis and your mindset is amazing. I love that. Powering diversification with alternative investment solutions and the democratization of alpha is just amazing. Thank you so much.
Yeah, thanks, Rosanna. A real pleasure. Thanks for having me on the show.
Absolutely. Thank you. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on the Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.